In the next few minutes, I'm going to save you 2 straight hours of listening to the Deckers earnings call, and we're going to uncover exactly why they just crushed their Q4 expectations. If you've been wondering whether HOKA's massive hype train is finally starting to slow down, or what kind of unique insights we can pull from their global strategy, well, you are in the exact right place. We're going to distill everything you actually need to know about this US stock, completely leaving all that corporate fluff behind.
Here's our roadmap for today's explainer. We'll start with the Q4 earnings surprise, look at HOKA and UGG's total dominance, unpack a literal masterclass in inventory management, highlight some real warning signs for Q1, and then map out FY27 and beyond.
All right, let's jump right into Section 1, the Q4 earnings surprise.
So Deckers delivered an earnings per share of 96 cents, which beat market expectations by a massive 16%. Now, what's really fascinating to uncover here is the contrast. Overall net profit was technically down 11% year over year to $140 million, but because they absolutely crushed both revenue and margin expectations, they just soared right past analyst models. Total revenue actually jumped 10% to $1.12 billion. That proves consumer awareness, especially for their flagship brands, is honestly stronger than ever.
But here is where it gets really interesting. Look at this geographical divide. That $1.12 billion in revenue, it was entirely driven by international markets, which account for about 42% of total sales. International growth accelerated to a staggering 26% year over year. Meanwhile, the US market, which makes up the remaining 58%, was completely flat. So what does this tell us? Deckers is successfully exporting its brand power right now, but they might be reaching a bit of a saturation point or a macro plateau domestically.
And the absolutely crucial point here is pricing power. Despite all the global pressures out there, gross margins actually increased by 0.8 percentage points to 57.6%. How do they pull that off? Well, they successfully sold more shoes at full price, they managed their foreign exchange and product mix favorably, and they completely offset the negative impacts of tariffs. Add in some incredibly tight operating expense controls, and their operating margin came in at 14%, which easily beat the market's 12.5% expectation.
Moving on to Section 2, HOKA and UGG dominate. These are the brand powerhouses.
This revenue breakdown brilliantly illustrates HOKA taking the lion's share of the business at 60%. They're followed by UGG at 37%, which leaves just a tiny 3% sliver for the rest of their portfolio, and that remaining 3% actually saw a 36% decline. So what does this mean for you as an investor? Basically, Deckers is a two-horse race. But let's be real, those two horses are moving incredibly fast.
Let's take a closer look at the lead horse here. HOKA hit a record-breaking $670 million in a single quarter. That is up 15% year over year. A lot of this was driven by the wildly successful relaunch of the Bondi 7 back in February. Over in the US, HOKA maintains the dominant market share for road and trail running shoes priced over $140. And globally, it's just as impressive. They are now a top 3 high-performance running brand in France, Italy, and the UK. Their direct-to-consumer business grew 18% globally, and wholesale grew 13%. And hey, right on that high note, if you want to stay updated on the latest US stock market news and uncover the real story behind corporate earnings, make sure to subscribe to my channel. I upload new explainers every week.
All right, Section 3, the Inventory Masterclass. This is all about engineering scarcity.
For Q4 FY26, Deckers drove their inventory turnover days down to just 106 days. To put that into perspective for you, while it is a seasonal increase from the previous quarter, it's dramatically lower than their 8-year historical average for this time of year, which normally sits way up at 130 days. That is a massive operational shift.
The big so what here is their brilliant psychological strategy. Management is intentionally keeping supply tight. By maintaining these lower inventory levels, consumers feel like the shoes are constantly selling out. This perceived scarcity forces shoppers to just buy immediately at full price, rather than waiting around for some end-of-season discount. And on the business-to-business side, it makes wholesale partners panic just a little bit. It encourages them to place much larger future orders just to ensure they don't run out of stock. It is literally textbook demand generation.
Let's shift gears to Section 4, warning signs for Q1. We have to talk about the macro hurdles.
Management actually missed Q1 expectations across the board here. They guided for an EPS of just 82 to 87 cents, which implies an ongoing earnings decline for the immediate quarter. Why is this happening? First, they expect gross margins to drop by 1.2 percentage points, down to 56.5%. They directly cited rising raw material and shipping costs driven by conflicts in the Middle East. Furthermore, operating expenses are expected to grow at twice the rate of revenue. But the biggest red flag? Management explicitly noted a shift in consumer behavior toward promotion-driven purchasing. Basically, people are hunting for deals right now. To combat this, Deckers is carefully managing their product pipeline, most notably planning to drop the new Clifton Pro in July to help stimulate demand.
Section 5. FY27 and beyond. Let's zoom out and look at the long-term marathon.
Looking at the full-year FY27 picture, management is actually guiding above market consensus. They're projecting EPS up to between $7.30 and $7.45 per share, and expecting overall revenue to grow 7 to 8%. Their plan is to carefully expand HOKA into higher-end sporting goods stores where their penetration is still pretty low, while UGG targets the over 65 demographic and the men's markets. And remarkably, actually, this is a detail a lot of people might miss. This strong EPS guidance doesn't even include a massive $120 million government tariff refund that they've already paid and are actively negotiating to get back. That right there could be a huge hidden catalyst.
Building into their multi-year outlook, the FY28 to 30 targets map out perfectly. I highly recommend grabbing a quick screenshot of these projections. They show steady, high single-digit revenue growth annually. HOKA is expected to keep growing at a low double-digit rate, with UGG holding at mid-single digits. But most importantly, they project operating margins staying exceptionally strong in the 20 to 25% range. That's going to drive steady EPS growth over the next few years.
Which brings us to our final section, Investor Takeaways. Now it's your turn.
So we've covered the explosive international growth, the brilliant scarcity tactics, and the looming macro risks. Now I want to turn this over to you. I want to hear from you in the comments. First, based on what we just broke down, do you think Deckers' low inventory, full price strategy can actually survive a consumer base that management admits is aggressively hunting for discounts? And second, and very importantly, which US company would you like me to create an explainer on next? Drop your thoughts down below, let's get a real discussion going, and I will see you in the next explainer.